All right, going live in 1, 2, 3. Just wait.
Hello and welcome to the webinar session with myself, David Madden. I'm a market analyst for equity capital based in London, and which is a part of the overall equity group. And as you know, there are multiple entities within the equity group itself, most notably FX Pesa in Kenya and Equity Nigeria. So today's webinar, before we get into it, I just want to leave the risk warning on on screen here. It essentially states that anything that I cover in this update should not be construed as investment advice or trading ideas, just merely my own thoughts and comments on what's going on in various different markets. So before we get into it, before we have the risk warnings out of the way, I'll take a look at some of the major markets and talk about what's going on from both a fundamental analysis point of view and also from a technical analysis point of view. So I'm looking here at the chart of silver, and as we can see here, the kind of overall trend has been to the upside. It was only a few weeks ago we saw silver hit a multi-month high in light of the conflict of what's going on in relation to Russia-Ukraine. What's been the drivers of this market? Well, it's worth noting that prior to the Russian invasion of Ukraine this day last week, it's worth remembering that silver was already in an upward trend. Why was this? Well, obviously the global economy came to a grinding halt in 2020 because of the lockdowns as a result of the pandemic. But what governments did around the world was pumping hundreds of billions or even trillions of dollars worth of stimulus packages to reinvigorate the economies. With that, we also had very loose monetary policies from central banks in terms of easing programs and interest rates being slashed. So we saw a turnaround in the global economy in 2021, spilling over to 2022. You could definitely argue that the rate at which the global economy is rebounding is cooling, which is certainly the case, but it's still in pretty good shape. So in terms of the rebound of the global economy has increased demand for metals and minerals across the board, including silver. That was the theme of the theme of late 2021 and also into 2022. What's also been going on more recently, because this day last week, the sad story of the violence we're seeing in Eastern Europe when Russia invaded Ukraine. What we've seen here as well is also more recently supply concerns. Russia is one of the largest silver producers and silver miners in the world. I think it's in about the 6th place, or at least in the top 10 in terms of production of silver. And with that, what we've actually seen here, and my apologies, I do apologize for that. I kept on saying the word silver throughout this session when it was actually gold. I do apologize about this. Sorry about that. It clearly says XAU. I was thinking of silver earlier on in the day, and I've clearly talked here about the price of gold. So what we can see here is that the gold market has been in quite a good shape, essentially throughout the beginning of the year. It was already pushing higher. It really ramped up in terms of its upward move. That the levels that we saw this day last week were the highest levels seen in 13 months. So it was a 1-year high. This was largely driven by fears about what's going on between Russia and also Russia and Ukraine. The invasion of Ukraine prompted a major sell-off in global stock markets, and in turn, traders are looking for assets that are considered to be lower risk. And one of the more oldest investment tools in the world is, of course, gold. Once again, I apologize. I mentioned silver a few times, but when I was really had the gold chart in front of myself, the flight to quality play became a big factor in this. So hence why we saw a sharp move to the upside in gold. Its highest level in 13 months. What's also going on is supply concerns. The problem with the sad story, the sad reality of violence and the war in Eastern Europe, that's likely to have a ripple out impact in terms of just the supply chain. Can goods and items and raw materials get moved from A to B? In a scenario like this, traders tend to be fearful for the worst case scenario. They assume that normal business activity gets disrupted, and in turn, anything from machinery won't be able to get from A to B, or raw materials won't be able to get from A to B. And in turn, there are concerns that the overall impression is that things are going to get worse before they're going to get better in terms of returning to normal activity. Hence why we've seen a continuation of the broad upward move in gold. Now, looking at the price action here, I'm looking at a 4-hour chart here in front of me. What we can see here is that although it did hit a 13-month high this day last Thursday, we then saw a sharp decline in the price of gold last Friday because there was announcement of peace talks between Russia and Ukraine. Sadly, nothing came of those talks, and we saw continued violence throughout the week. And in turn, once again, the kind of flight to quality play came back into focus. We saw a continuation of the upward move in gold here, which has been in the play for the last few days. It's back above all three of these simple moving averages. While it continues to hold above these three simple moving averages, it's likely that the broader upward trend will continue. A move higher from here could see it retest the 13-month high of 1974, and a break beyond that could see it target the psychologically important $2,000 mark. If we do see any moves to the downside in gold, because let's face it, if you look at the MACD indicator here, we can see that momentum is in negative territory, suggesting the bears are in control. It's also worth noting that if you look at the more shorter term trend on gold, it has been to the downside in the past. Over the last several weeks, it's clearly been to the upside. But if you do see it continue, we could head back down toward this area here at 1890, and a break below that could see us down toward this zone here in around 1878. Now, I talked about how stock markets around the world suffered greatly because of the conflict seen in the last week. But it's also worth noting that stock markets around the world were already in a downward trend from about kind of early to mid-January onwards. Why was this? Well, one of the elements of the post-pandemic boom, which I touched on when I was talking about gold, was that the global economy essentially was closed down for an extended period in 2020. Then it was reopened. Governments were spending money. Central banks were printing money as a way of turning the global economy around, which has been a success. The cost of those policies has been higher inflation. Inflation in the US is level in 40 years. So if your wages are only growing, say, an average of 5.5% per year, but inflation or costs of everyday life is increasing at a rate of 7.5%, you're net worse off. So the high levels of inflation brought about fears and speculation that we're going to have higher interest rates from the Federal Reserve coming onto this point here. And we saw from the update from the Federal Reserve, the US Central Bank in late January, the update that they gave, the head of the Federal Reserve, Jerome Powell, didn't rule out the possibility of hiking interest rates at all 7 meetings this year. Now, in the immediate aftermath of that particular Fed meeting in late January, the Fed funds futures market began to price in 5 interest rate hikes from the Federal Reserve this year. So we were always seeing a decline in stock markets. Why is this? Well, some of the money that is moving around the stock markets around the world is actually borrowed money. So the higher rate of interest rates, therefore it essentially puts pressure on those who are borrowing money to invest in the stock market. It's also worth noting, in a very, very low interest rate environment, which we've seen essentially for the past 2 years because of the pandemic, when interest rates are almost zero, therefore some people who would ordinarily have their cash sitting in bank accounts earning a bit of interest, thinking to themselves, why should I have cash sitting in the bank account? I may as well have it in stocks, which throughout the latter half of 2020 and a lot of 2021 were growing at a considerable rate. Many stock markets were. We also saw companies paying decent dividends as well. So stock markets, on account of the low interest rate policy, almost zero interest rate policy, elevated stock markets. Some would argue they were overstretched and overvalued. Then the prospect of higher interest rates encouraged some people to say, you know what, perhaps the party is over in relation to almost zero interest rates. And now it looks as if we're heading towards a period of higher interest rates. And in turn, we're seeing downward move in stocks. Finally, more recently, the extra leg lower that we saw here on this day last week was brought about by the kind of surprise Russian invasion of Ukraine. Now, we've seen here a sharp move to the downside in the US 30. obviously the US 30, in the US economy is geographically removed from Eastern Europe. So therefore, we have seen a bit of a bounce back. But that being said, we're still holding below this 100 period moving average here. Once again, I'm looking at a 4-hour chart. So that kind of a more medium-term trend for the US 30 is still very much to the downside. But we continue to hold up below this moving average here at the 100 period. It's like it's a more broader medium-term downward trend will continue. Moving lower from here, we could potentially look to find support in around this area here, around 33,103. It's going to break below that. Could see a target this area here around 32,827. And of course, if you go below that again, we could then be looking at retesting the lows of late February. Now, if you take a look at the MACD indicator, we can see that momentum is in positive territory. If you take a look on the more broader medium term on the RSI, it's broadly been moving higher as well. So the fact that the momentum is in positive territory suggests the bulls are in control. The fact that the RSI is broadly moving higher suggests the price bias is to the upside. So if we do see a continuation of this short-term upward move in the US 30, because let's face it, it has been recovering since the lows of last week. If we do move higher from here, we could have to target this zone here around 34,417, and a break beyond that could target this region here around 34,924. Coming on now to the US dollar versus the Canadian dollar. Well, we've had a number of different factors going on influencing this currency pair. I mentioned on the previous chart I was looking at about how in late January rather, there was an update from the Federal Reserve, and the Fed funds futures market started to price in 5 interest rate hikes from the Federal Reserve this year, and in turn we saw a broad rally in the US dollar. Hence why we saw a sharp move to the upside here in the currency pair, because it's the US dollar versus the Canadian dollar. But at the same time, with other factors going on as well, we had a fairly strong oil market, a strong rally in the oil market. The Canadian economy has a disproportionately large energy sector, oil and gas, and in turn, whenever you see strength in the oil market and the gas market, you tend to see strength in the Canadian dollar. So when we saw a rally in the price of oil, that puts some downward pressure on USD CAD, largely because of what's going on with the oil market. As we've known in the last few days and weeks, oil is kind of moved from strength to strength. We're already seeing multi-year highs in the oil market being racked up prior to the Russian invasion of Ukraine. So that's been a factor pushing this currency pair lower. Only as of yesterday, we had an interest rate hike from the Bank of Canada. I talked about how global economies are recovering, and some of them are actually enduring fairly high levels of inflation. One way to tackle high levels of inflation is higher interest rates. So with that, we've seen the Bank of Canada kind of move towards a policy of actually hiking interest rates. And then, of course, also what's going on with the situation between Russia and Ukraine. Russia is obviously a major exporter of oil. There are concerns that many potential buyers of Russian oil around the world will turn their backs on Russia and refuse to buy energy from Russia, oil from Russia, because they don't want to be seen to be supporting a state which actually has carried out an invasion and is still occupying parts of another sovereign state. With that, we've seen a sharp move to the upside in the oil market. Hence why we've seen a strong Canadian dollar and in turn a sharp move lower in USD CAD. Now, in the last few hours, the oil market has retreated a little, and in turn we've seen a bit of a move to the upside in USD CAD. But it's worth noting, only this morning, like the currency pair fell to its lowest level since late January. So we've hit a 4 or 5 week low in USD CAD. The more medium-term trend for the currency pair has been to the downside. Even though we rebounded somewhat, we didn't actually get back above the 100 period moving average here. In fact, it acted nicely at resistance here. Once again, I'm looking I'm looking at the 4-hour chart here on USD CAD. What we can see here is in relation to the USD CAD. What we can see here is What we can see here is the clear example of how much aggressively lower USD CAD has been moving. If we continue to hold below these two simple moving averages, actually in fact all three moving averages, if we continue to hold below those, it's likely the broader bearish trend will continue. A move lower from here, could see it retest the lows of this morning in around 1.2586, and a break below that could see a target down towards 1.2558. Taking a look at the MACD indicator, we can see that negative momentum is in decline, suggesting the bears are no longer as influential as they once were. Taking a look at the RSI, we can see it's off its recent lows and it's edging higher, suggesting the price bias is to the upside. If we do see a continuation of the short-term upward move in USD CAD, resistance could be encountered from this zone here around 1.2744, and a break above that could target this region here in 1.2808. Now, one of the things to keep in mind then is that I left this intention down here, the Federal Reserve to hike rates kind of question mark, because although the Bank of Canada hiked interest rates yesterday, it's worth noting that despite the conflict in Eastern Europe, in the last 48 hours, we have heard from Jerome Powell, the head of the Federal Reserve, and he said only yesterday it would be appropriate for the Federal Reserve to hike interest rates later on this month. It's possible that some central banks around the world might look at the war in Eastern Europe and think to themselves, you know what, this is likely to ripple out across the global economy. Let's not get ahead of ourselves and hike interest rates too many times this year. So it's possible that we could see the Federal Reserve, it's quite likely we could see the Federal Reserve hike interest rates later this month. But times have changed since late January or early to mid-February, prior to the Russian invasion of Ukraine. And with that, we could see central bankers move towards hiking interest rates, but perhaps not as many rate hikes as expected. So when we had a strong US dollar here in late-ish February, that was at a period where traders were pricing in about 5 interest rate hikes from the Federal Reserve. We now could be looking at a scenario in light of the war in Eastern Europe, where we only have 2 or possibly 3 interest rate hikes this year, depending on how things play out. So keep in mind, if you're going to be trading the US dollar or any dollar crosses, keep in mind we could be in for an interest rate hike from the Federal Reserve later on this month. Now, speaking of the oil market, we can see here that a combination of factors were going on. The oil market was already in a fairly clear and obvious rally prior to the Russian invasion of Ukraine. So this was already in play for a number of factors. Most notably, the kind of post-pandemic economic boom. I talked about how the global economy has been kind of moving from strength to strength in the last about 12 to 9 months. You could argue that the rate at which the economy is rebounding is slowing down and is tapering off. But nonetheless, the economy is in a far better position now than it was this time 2 years ago or this time 21 months ago. So the oil market, as you can see here, was already rising. Then, of course, what we had this day last week between the Russian invasion of Ukraine, what we've seen with that is a sharp move to the upside in the price of oil, because Russia is a major exporter of energy. And as I mentioned a moment ago, some companies don't want to be seen to be dealing with an aggressor. So in turn, they're turning their backs on Russian oil. In turn, that kind of puts pressure on supply. There's also fears if the conflict continues and rumbles on and gets worse and worse, we could just have logistical issues in terms of actually getting the oil across from country A to country B. Also, what we had in the last 48 hours was OPEC Plus, the group of oil producing nations, come out and basically state, we're keeping our policy plans on hold. As of next month, the OPEC Plus body will increase its output of oil by an additional 400,000 barrels of oil per day, which is essentially in line with their exact policy. Even though there were many kind of, some people out there were kind of hoping they might look to actually ramp up the rate at which they're increasing production as a way of taking some of the pressure off of what's going on in the oil market. Obviously, if you're an oil producing nation, you stand to benefit by a higher oil price. But as I mentioned about 5 or 10 minutes ago, the high levels of inflation is an issue for countries that actually are net importers of oil. Now, the problem where the oil producing nations have to strike a balance is they want to get as high a price as possible, but not such high a price that all of a sudden inflation goes through the roof. Consumer demand starts to get chipped away at because people's essentially savings are being eroded. Governments around the world, as a way of tackling or central banks around the world, as a way of tackling high inflation, start to hike interest rates, which in turn kind of puts the brakes on their economic growth, and therefore, down the line, 6 months, 9 months, 12 months down the line, kind of chips away at their demand for oil. So it's a fine balance that needs to be struck here. Yesterday we had the OPEC decision, and earlier today we saw US oil hit its highest level since 2011, which really underlines how bullish the recent run has been. In the last few hours, we have seen a reasonably large pullback in the price of US oil, but nonetheless, we can see here that it found support nicely from the 20-period moving average here, which comes into play at this green line here. At this point out, I'm looking at once again at the 4-hour charts. While the market continues to hold above these 3 simple moving averages, it's like the recent upward trend will continue, moving higher from here. We could have to retest the recent peak at $114.53, 114.53. If you break above that, we could then be heading up towards $116, $118, and then 120 will be the next big level to watch out for. Now, taking a look at the MACD indicator, it may come as wasn't exactly a total shock that the price of oil retreated in the last basically throughout today's session. And why is this? Because if you take a look at the price of US oil in the past 48 hours, the price was going steadily higher all the way along here. But if you take a look at the MACD indicator, we can see there's a clear decline in positive momentum. So it's almost as if the buyers were they were still driving the price higher and higher, but they were doing it at a slower rate. It's almost as if the bulls were kind of running out of energy, running out of steam. So with that, it wasn't a total surprise that the market moved lower, because if you read about the MACD indicator and what its relationship with the price, if there's a divergence between the two, whereby the price is going higher but positive momentum is going lower, that could be, not always, but it could be an early warning sign that change in trend or a bit of a pullback is in the offing or is about to appear on the horizon. It's also worth noting, if you look at and looking at the RSI here, it moved into overbought territory. Once again, an often early warning sign that the upward movement price has become overstretched. But nonetheless, even though US oil has pulled back, it's still comfortably above all 3 simple moving averages. So while it continues to hold above those metrics, I think the kind of more medium-term uptrend will continue. Coming on now to the euro versus the Swiss franc. So the eurozone economy is very much tied in with Russian energy. Major eurozone economies such as Germany and Italy, about some of the region of say 55% for the Germans, about 45% for the Italians. For a large chunk of their natural gas imports comes from Russia, and the fear is if the European Union or the Western economies seem to actually come down heavy on Russia for invading Ukraine, there's a fear that Russia or Moscow might turn off the tap or deliberately squeeze energy supplies into Central Europe as a way of retaliating back at them. And with that, people are essentially turning their back on the single currency, the euro, because they're afraid through indirectly the amount of exposure the eurozone economy depends on natural gas and coal and also oil from Russia. On the flip side of it, the currency pair, the Swiss franc. The Swiss franc has been a classic safe haven play for as far as currencies are considered in Europe. Over the Far East, Japan is considered to be the safe haven currency over there. To an extent, in the last few months and the last year or two, the US dollar has been a bit of a safe haven play, but the Swiss franc and the Japanese yen have been big safe haven plays. So when the Russian invasion of Ukraine took place this day last week, we saw a sharp move to the downside in the euro versus the Swiss franc. The euro was prior to the invasion, the euro was at a reasonably elevated level because inflation in the eurozone was at its highest on record. I talked about high levels of inflation as a consequence of the post-pandemic boom. at the most recent ECB meeting, the European Central Bank meeting, the European Central Bank said it'd be foolish to rule out the possibility of hiking interest rates this year. Now, that isn't exactly a hawkish update, but it was considered to be more hawkish than what people were thinking of when it came to potential ECB policy. So the euro was at a reasonably elevated level. It was already drifting a little bit lower, and then we had the Russian invasion of Ukraine. So combination of all the above, combination of all of the above has led to the price action seen recently. In the last 48 hours, we've seen Euro Swiss, this currency pair here, fall to a new 7-year low, and that's back to a level last seen in 2015, which really underlines how bearish the recent downward move has been. While it continues to hold below these 3 moving averages, it's likely the more broader bearish trend will continue. Moving lower from here, we could be looking at targeting 1.0100, and a move below that could see us down to 1 parity between the euro and the Swiss franc. Now, if you take a look at the price action, we can see it's been moving aggressively lower in the last few hours. If you look here at the RSI, it's moving lower as well. It's quite close to being in oversold territory. Now, if it does move into oversold territory, that could be an early warning sign to say, you know what, the downward move has been a bit overdone. We could be in for a bit of a snapback. There's no guarantees, but that's a possibility. And if you do see a snapback in Euro Swiss from here, where could we go? Well, we could head back up towards this area here. We saw a number of peaks in this area here, potential resistance zone that comes into play in around 1.0296, and a break above that could see a target this zone here, this peak here in around 1.0378. Sticking with the theme of the eurozone and European economy is being fairly reliant on what's on the German natural gas in Germany. This is exactly what we're seeing here in relation to the DE30, the German stock market. Now, it's worth noting, even before we had the Russian invasion of Ukraine, it's worth noting we had an all-time high set in the German stock market. Germany's economy was performing quite well. And in turn, it was in quite a good shape. In turn, the DE30 was in quite a good shape. In fact, the DE30 was at an all-time high at the very beginning of January. Then, of course, we had a bit of profit taking. We had creeping fears about higher inflation across the West, really across Germany, across the Eurozone as a whole, the UK, the Federal Reserve. We talked about how the Dow Jones was already drifting lower from about mid to late January onwards because of the possibility of the Fed hiking rates on numerous occasions this year. We were already moving lower on that talk of both higher inflation and potential higher interest rates. Then more recently, this day last week, we had a sharp sell-off because of the Russian invasion of Ukraine. We can see here that the lows we've set in the last few hours of the DE30 have managed to drop below these lows here. So which really kind of underlines how bearish the recent move has been. We're not back to levels last seen. Back to levels last seen in over a year, basically. We're not talking back to levels of about 13-month lows being set on the DE30 in the last few minutes, really. So that really kind of underlines how bearish the recent move has been, or the current move has been. If it continued to move lower from here, we could be looking at targeting 13,270. So keep an eye for that level to the downside. If we do manage to kind of stage a rally from here, where can we look to head back up to? Well, we could look at retesting some of these peaks along here, most notably in around this region here of 14,477. And if we break beyond that, we could then be looking at targeting this area here at 14,676. Now, it's just before we finish up, because it's just gone half past the hour now. If you take a look at the rallies we've seen in the DE30 recently, notice how on very few occasions, although we've had numerous rallies because there was moments of relief thinking that this conflict might be solved politically. Notice how the rallies that we've seen here, they've never really managed to actually take out previous peaks. The rally that we saw here failed to clear this peak. The rally we saw here failed to clear this peak. The rally we saw here failed to clear this peak. So when we continue in this trend of lower, a clear example of lower peaks, it's like it's a broader bearish trend in the DE30 is likely to continue. I do, for all of those who've tuned in to the live recording, I appreciate your time, and feel free to sign in next week. That's all for me. I've been Dave Madden. Thank you very much.